Most traders don't blow up because of bad entries. They blow up because of bad size. You've seen it happen. Maybe you've lived it yourself. Monday you make $350. Clean trade, disciplined execution. Tuesday, another 200. You feel invincible. You feel like you've finally cracked the code. Wednesday arrives with the same setup, same market conditions, but something is different. You're not trading the market anymore. You're trading your feelings about Monday and Tuesday. You size up. You double your position because you want to hit that $1,000 milestone faster. The trade goes against you immediately. But instead of cutting it, you freeze. Because the position is twice as big, the loss is growing twice as fast. You're down $500 in minutes. Panic sets in. You move your stop loss because you cannot accept that Monday and Tuesday's profits are gone. You tell yourself it has to turn around. It doesn't. Now you're down $1,800. Your entire week, plus a chunk of your principal, has vanished in 1 hour. That isn't a chart problem. That isn't a broker problem. That isn't the market being manipulated against you. That's a position size problem. And until you admit that, you'll keep repeating the same cycle. Small win, oversized bet, big loss, emotional spiral. Repeat. Here's the brutal truth that separates amateurs from professionals. If you can't control position size, you will never consistently hold $500 daily profits. Not on 1-hour charts. Not on 5-minute charts. Not on any time frame in existence. You might touch $500. You might even hit 1,000 or 2,000 on a lucky day. But you will not keep it. It will bleed back out on the days when your size is driven by fear or greed instead of mathematical rules. Most traders think they understand risk management because they use stop losses. Using a stop loss doesn't mean you understand position sizing. It means you know where you're wrong. That's only half the equation. The other half, the half that actually determines whether you survive in this business, is knowing exactly how much you're risking before you ever click the buy button. You can have the perfect entry, the perfect stop loss placement, and still get destroyed if your position size is wrong. Jesse Livermore understood this over a century ago, back when trades were written on paper and prices came through ticker tape. He wasn't playing guess the top, guess the bottom. He wasn't obsessed with calling market turns or finding the perfect indicator. He was obsessed with one thing: control the bet. Control the risk. Control how much he could lose on any single idea before it was proven right. But here's what makes Livermore's story so powerful. He went bankrupt 3 times before he finally cracked the code. 3 times. This wasn't some amateur off the street. This was a man who famously made $1 million shorting the 1907 panic. A man who made $100 million shorting the 1929 crash. Yet he still managed to lose everything multiple times in his career. Why? Because early in his trading life, he had incredible market intuition but zero position sizing discipline. He would make fortunes and then give them back, not because he suddenly forgot how to read the tape, but because he couldn't control his bet size when emotions ran high. Amateurs trade to make $500. They wake up with a number in their head. If I can just make $500 today, I'm good. So every decision gets filtered through that emotional target. They overtrade when they're down. They overstay when they're up. They treat every setup like a chance to hit the magic number. This is the most dangerous sentence in trading. I need to make $500 today. When you focus on the $500, you're focusing on something you cannot control. You cannot force the market to give you $500. Professionals don't trade like that. Professionals structure their day so that $500 becomes a byproduct of a repeatable risk formula. They don't chase the money. They chase the execution. The professional wakes up and thinks, what is my maximum acceptable damage today, and how do I structure my trades inside that limit? One approach is dreaming. One is operating. Think about your last losing streak. Not just one bad trade, but a stretch where you felt like the market had turned against you. You didn't just lose money. You lost discipline. You started the week with rules. Fixed stops. Defined risk per trade. Clear criteria for when to trade and when to stand aside. Then a couple trades went wrong. Maybe it was minus 200, then minus 350. Suddenly you weren't thinking about setups. You were thinking about getting back to break even. You went from systematic to reactive. You increased size to get even faster. You told yourself, this is the one. If this wins, I'm back on track. You moved stop losses to give trades more room, but really it was to delay taking the loss. You justified it as letting the trade breathe, but you knew the truth. You couldn't accept that the idea was wrong. And in that moment, you weren't trading a market anymore. You were trading your ego. This is where the professional mindset is brutally different. A professional sees a losing streak and thinks in risk units, not dollars. I've lost 2R today. My plan allows a maximum of 3R. One more clean attempt, then I'm flat for the day. That last phrase is key, flat for the day. Waiting is a position. Zero exposure is a valid position size. Stepping aside is an active decision, not a failure. Most amateurs hate that idea. They feel guilty when they're not in a trade, as if being flat means they're missing out or not working hard enough. So they confuse activity with productivity. But trading isn't a 9-to-5 job where more hours equals more pay. In trading, the person who waits for 3 high-quality 1-hour setups will almost always outperform the person who clicks buttons 30 times a day with no risk framework. The difference between Livermore's final fortune and his earlier bankruptcies wasn't better market analysis. It was position sizing discipline. He developed a mathematical framework that turned random-looking trading days into controlled risk units, not dollar fantasies. He stopped asking, how much can I make today? And started asking, how much am I willing to lose on each individual trade, and how many trades am I willing to take? Those 2 questions changed everything. In this video, we're breaking down what I call Livermore's $500 daily formula. Not a magic indicator. Not a secret pattern that never fails. Not a guru signal service. A position sizing framework specifically designed for 1-hour charts that caps your daily damage, scales you into strength, never into weakness, and lets you trade like a professional operator even with a modest account. Whether you're working with $5,000 or $50,000, the logic is the same. The math adjusts, but the principles don't. Here's what most trading educators won't tell you. The market doesn't care about your $500 daily goal. The market doesn't care that you need to make $2,000 this week to pay your mortgage. The market doesn't care that you're down $400 and need one good trade to get back to even. The market is completely indifferent to your financial needs, your emotional state, and your personal goals. The only thing you can control is your position size and your risk per trade. Everything else is probability playing out over time. We're going to pull this apart step by step. You'll see how a professional thinks about daily risk long before they think about daily profit. You'll see why the size of your position should always be dictated by the distance to your stop, never by how good the setup looks. You'll see how to build into a winning trade, the way Livermore did. Small at first, adding only when the market confirms your idea, never when it contradicts you. But before we do any of that, you and I need to confront one simple question. It's a question most traders cannot answer clearly, and their account balance shows it. Here it is. If you're wrong 3 times in a row today, exactly how much do you lose? Not roughly. Not around this amount. Not depends how I feel. In exact dollars. 3 trades. 3 losers. What is the total hit to your account? If you can't answer that in one sentence, with a specific number, you are trading like an amateur, no matter how many screens you have or how long you've been in the market. Because that means your risk isn't defined. It means your account is exposed to your mood, your frustration, your impatience. Professionals never give the market that kind of access to their capital. They decide in advance how much of today's capital is at risk. They translate that into a fixed risk amount per trade. Every position size, every stop loss, every scale-in is built backwards from that number. That calm control isn't an accident. It's a result of structure. Before you ever allow the thought of $500 profits to enter your mind, you need one precise number burned into your consciousness. What is my 1R? What is my standard risk unit per trade on the 1-hour chart? This isn't a suggestion you consider when you feel like it. This isn't something you figure out as you go along. This is the foundation of everything. Without it, you're gambling with different bet sizes based on emotion, and that road always leads to the same destination, a blown account. Jesse Livermore never used the term 1R. That language came decades later from traders like Van Tharp who formalized position sizing theory. But Livermore lived by the exact same principle over a century ago. He always knew, before he placed any position, exactly what he stood to lose if he was wrong, not approximately, not somewhere in the ballpark. He knew the precise dollar figure. If this trade goes against me, I lose exactly X dollars. That clarity was his edge as much as his legendary tape-reading ability. Most traders operate in a dangerous fog of approximation. They see what looks like a good setup. They grab their usual position size, maybe one standard lot, maybe 5 mini lots, and they place a stop loss somewhere that feels right. They have no mathematical relationship between their risk and their position size. They're essentially throwing darts blindfolded, hoping something good happens. That's not trading. That's hoping with leverage. Let's build your professional framework from the ground up, the same way Livermore eventually learned to structure his approach. We start from the top down, not the bottom up. Most amateurs start with the chart. This setup looks incredible. How much can I buy? Professionals start with the account. What is my maximum daily damage, and how do I structure my trades within that limit? Your maximum daily damage is the amount you can lose in a single trading session without affecting your psychological state or your long-term capital preservation. This isn't just about the money. It's about your mind. If you lose this amount, and you're still calm, still systematic, still able to follow your rules tomorrow morning, then it's the right number. If you lose this amount and you're angry, desperate, or plotting revenge trades, it's too high. For most serious traders who want longevity in this business, maximum daily damage represents 2 to 3% of total account equity. Let's work with a concrete example. You're trading a $25,000 account. 2% of $25,000 equals $500. That becomes your entire war budget for today. Your absolute ceiling. The line you will not cross, regardless of how good the next setup looks or how sure you feel about your analysis. Here's where amateurs and professionals diverge completely. The amateur looks at that $500 budget and thinks, great, I can risk $500 on this one trade because it's my best idea. That's not risk management. That's Russian roulette with your entire daily allocation. One unexpected news event, one stop hunt, one moment of slippage, and your entire day is over before you've learned anything useful. Professionals ask a different question. How many bullets do I want to fire today? How many high-quality attempts do I want to take at the market before I've exhausted my risk budget? They don't spray 15 random shots hoping something connects. They plan their number of serious attempts in advance, based on realistic expectations for how many legitimate one-hour setups they'll actually encounter. Let's say you decide on 3 trades maximum. 3 high-probability setups that meet your criteria. Not 3 trades because you need to stay busy. Not 3 because you feel pressure to be active. 3 because historically, on one-hour charts, you see 2 to 4 genuine opportunities per session that align with your edge. Now the mathematics become beautifully simple. Take your maximum daily loss and divide by your planned number of trades. $500 divided by 3 trades equals $167 per trade. That's your 1R. Your risk unit. Your standard ammunition. Every trade you take today, if it hits your predetermined stop loss, costs you exactly $167. This precision matters more than most traders realize. When your risk is fuzzy, your decisions become fuzzy. When your risk is exact, your decisions become binary. Either this setup justifies risking $167, or it doesn't. There's no middle ground, no sort of taking the trade with half size, because you're not completely convinced. Now let's translate this into actual position sizing on your screen. You're watching year USD on the 1-hour chart. You identify a clear resistance level that has rejected price multiple times. You see a potential short setup developing. You examine the recent volatility and determine that your stop loss needs to be 25 pips above the resistance to avoid getting stopped by normal market noise. Here's the calculation that separates professionals from gamblers. If your 1R equals $167 and your stop distance is 25 pips, then your position size must be 167 divided by 25. That equals $6.68 per pip. That's your exact position size, not a round number. Not about $7 per pip. Exactly 668. You enter the trade with that precise size. If you're right, and your USD moves in your favor, every pip equals $6.68 of profit. If you're wrong, and price hits your stop 25 pips away, you lose exactly $167. 1R. You've transformed "I hope I make 500 today" into "I risk 167 per trade." Maximum 3 trades. Daily cap 500. But here's where the real power shows up. Imagine later in the session you find another setup. But this time, the market is more volatile. The candles are larger. To place your stop safely behind the structure, you need a 50 pip stop distance. Most amateurs would use the same position size they used earlier. They'd risk the same 668 per pip, not realizing they're now risking $334 on one trade. They've broken their rules without even knowing it. The professional adjusts automatically. The math doesn't change, only the inputs. $167 divided by 50 pips equals $3.34 per pip. Your position size drops to accommodate the increased volatility, but your risk, your 1R, remains exactly the same. Do you see what just happened? You neutralized volatility. You ensured that a stop trade on a calm day hurts your account exactly the same amount as a stop trade during market chaos. This consistency is what allows the law of large numbers to work in your favor over time. You've just made a profound psychological shift. Amateurs ask, "How much can I make on this trade?" They're imagining profits before they've defined losses. They're counting money that doesn't exist while ignoring the risk that's guaranteed to exist the moment they click buy or sell. Professionals start with the opposite question. How much can I lose without breaking my systematic approach? Not how much am I willing to lose if this makes me rich, but how much can I lose, repeatedly if necessary, while maintaining my discipline and emotional control? Once your losses are capped and predefined, something shifts in your nervous system. You stop defending individual trades. You stop moving stops because you can't accept being wrong. You stop adding to losers because you know it has to turn around. All those destructive behaviors stem from undefined risk. When you don't know exactly what you're losing, your brain panics and starts looking for escape routes. But when your risk is defined to the dollar, there's nothing to rationalize. You knew the cost before you entered. If the trade hits your stop, you lose 167. That was the agreement. You accepted it when you clicked the button. You mark it as -1R, analyze what happened, and move to the next opportunity if you have bullets remaining. This is what it means to defend your process instead of defending individual trades. This single trade is statistically meaningless. What matters is whether you're executing a system that over 100 trades produces positive expectancy. And you cannot have positive expectancy if your position sizing is random, emotional, or based on how confident you feel about each setup. The next chapter reveals how to convert these clean 1R units into consistent daily profits through Livermore's pyramiding protocol. Because here's what most traders miss. $500 isn't one lucky trade that goes your way. It's usually 2 to 4R extracted systematically across multiple positions, built carefully into confirmed strength, never into hope. Now you have your 1R foundation locked in place. You know exactly what you risk per trade. You've capped your daily damage. The defensive framework is bulletproof. But here's the critical question that separates traders who survive from traders who thrive. How do you convert those clean 1R units into the consistent $500 days you're after? The answer lies in what Jesse Livermore perfected over decades of trading, pyramiding into confirmed strength. With a $167 risk unit, a $500 day equals approximately plus 3R, not plus 10R. Not a miracle home run that pays your rent. Plus 3R. That's the realistic, repeatable target that professionals build their entire approach around. And here's the professional secret that rewires everything. Dollars follow R multiples. R multiples don't follow dollars. What does that mean in practice? It means you stop thinking, "I need to make $500 today," and start thinking, "I need to extract plus 3R from today's market conditions using systematic execution." The language shift seems small, but it transforms your entire decision-making process. You're no longer chasing a dollar figure that the market may or may not provide. You're executing a mathematical system that produces R multiples, and the dollars appear as a natural byproduct. Most amateurs think in single trades. They wake up believing they need one perfect winner, one trade that captures 50 pips from bottom to top and solves their daily target in one shot. That's lottery thinking. That's hoping the market delivers exactly what you need exactly when you need it. Professionals think in sequences of R multiples. They understand that a winning day is built from multiple decisions. Some winners, some losers, all sized correctly according to predetermined rules. Here's a realistic 1-hour scenario that demonstrates how a professional structures their day. Trade 1, -1R. You identified a clean breakout setup. You entered at the logical level with your predetermined stop 25 pips away. The market immediately rejected your thesis and stopped you out for exactly $167. No drama, no moving stops, no hoping it reverses. You took the loss, marked it as -1R in your journal, and moved on to scan for the next opportunity. Trade 2, +2R. You spotted a trend continuation pattern after a pullback to support. You applied the pyramiding protocol we're about to break down in detail. The market confirmed your analysis step by step. You scaled in properly as price moved in your favor. You exited systematically when momentum began to fade. The result, +2R, or approximately $334. Trade 3, +2R. A breakout setup appeared with strong volume confirmation. You used the same 3-stage pyramiding framework. Price broke through resistance, held the level, and continued with conviction. You built your position systematically and captured the move according to your predetermined exit criteria. Another +2R. Net result for the day, -1R plus 2R plus 2R equals +3R. That translates to $501. Notice something critical about this sequence. You had a loser. The day wasn't perfect. You weren't batting 1,000. But the day was built on systematic execution, not luck. You followed your protocol regardless of individual outcomes, and the mathematics worked in your favor. So how do you achieve those +2R trades consistently on 1-hour charts when your initial risk is only 1R? Through Livermore's pyramiding into strength protocol. This is where most traders destroy themselves because they pyramid in the wrong direction. When a trade goes against them, they add more size, hoping to average down and reduce their cost basis. They're adding weight to a sinking ship. They're increasing their exposure exactly when the market is telling them they're wrong. Livermore did the exact opposite. He only added to a position when the market proved he was right. He pyramided into confirmed momentum, using the market's own movement to finance additional aggression. Think of it like a military campaign. You don't send your entire army into unscouted territory. You send a small reconnaissance unit first. If the terrain is hostile, you retreat with minimal casualties. If the terrain is favorable and your scouts report success, then you send reinforcements. The framework has 3 distinct stages, each with a specific purpose and precise position sizing. Stage 1 is what professionals call the probe. This is your reconnaissance mission. You risk your full 1R calculation, but you only deploy 30% of your intended maximum position size. You're testing the market's reaction to your thesis without committing serious capital to an unconfirmed idea. Here's how it works with concrete numbers. Your USD is consolidating just below resistance at 1.1000. Based on your analysis of the 1-hour structure, you believe it's going to break higher with follow-through. But you're not certain yet. The market hasn't confirmed your thesis. So you enter with only 30% of your planned position size. Your protective stop is at 1.0975, 25 pips below your entry. That represents your full 1R risk of $167. But because you're only using 30% of your intended position, your actual position size is smaller than your maximum calculation. If this trade fails immediately, you lose your 1R, but you haven't committed your full intended capital to an unproven idea. This is the psychological breakthrough that separates professionals from amateurs. When you probe first with 30%, you remove the fear of being wrong with maximum size. You're not betting everything on an unconfirmed setup. You're testing. If you're wrong, you lose 1R on a controlled position. If you're right, you have room to scale in and capture multiples of your initial risk. Now price moves to 1.1025. That's 25 pips in your favor. The breakout held. Buyers stepped in above the resistance level. The market just confirmed your thesis. This triggers stage 2, the confirmation. You add 40% more size at this higher price, not at your original entry, at the current market price, which is now 25 pips above where you started. Here's the mathematical beauty of this approach. Your initial 30% position is now up 25 pips. That floating profit allows you to move your original stop to break even, or slightly above. You're now using what traders call house money to finance additional risk. Your account is no longer exposed to the original 1R loss because the market has already moved meaningfully in your favor. You've added 40% more size, so you now hold 70% of your intended full position. Your average entry price is somewhere between 1.1000 and 1.1025. Let's call it approximately 1.1017 for calculation purposes. You're in profit on your entire position, and you're building into confirmed strength, not hope. Stage 3 is the finisher. Price continues to 1.1050 with strong momentum. The 1-hour candles are closing decisively higher. Volume is confirming the move. This is where you complete your pyramid by adding the final 30% of your intended position. You now hold 100% of what you originally planned, but your average entry is 1.1017, well below the current market price. Let's calculate your total profit potential. Price continues to 1.1075 before showing signs of exhaustion. You exit your full position according to your predetermined criteria. Your average entry was 1.1017. Your exit is 1.1075. That's 58 pips of profit on your full position size. Total profit SEX 1.10751.1017, full position size, SEX 58, pips profit. At approximately $6.68 per pip for your full position. That translates to roughly $387, which is more than plus 2R on a single well-managed idea. But here's the key insight. Because you pyramided correctly, you captured far more profit than if you'd entered with full size at the beginning. If you'd gone all in at 1.1000 and price had immediately reversed, you'd have lost 1R on your maximum position. That's a much larger dollar loss than 167. By probing with 30% first, you protected your capital while still capturing the full move once the market confirmed your analysis. This is the mathematical elegance of Livermore's approach. Your initial risk stays fixed at 1R, but your profit potential expands exponentially because you're building into a winning position, not hoping a losing position reverses. Each addition is financed by unrealized profits from the previous stage. Each addition is made at a higher price for longs, which seems counterintuitive until you understand that you're buying strength, not weakness. Amateurs do the exact opposite. They enter with full size immediately. Price moves against them. They add more, thinking it has to turn around, and when it does, I'll recover my losses faster with a bigger position. That's pyramiding into pain. That's averaging down into a losing trade. That's how accounts die slow, agonizing deaths. Professionals pyramid exclusively into confirmed momentum. They start small with the probe. They let the market prove them right through price action. Then, they add size at higher prices for longs or lower prices for shorts, always building in the direction of the established trend, never against it. The market finances their aggression through its own movement. The psychological shift here is profound. When your initial risk is controlled at 1R and your position starts small, patience becomes directly profitable. You're not desperate to be right immediately because you haven't overcommitted. You can wait for confirmation. You can let the market show you it's ready to move before you deploy serious capital. Each stage of the pyramid requires the market to prove itself before you increase your exposure. Patience becomes profitable when your initial risk is controlled. You're not sitting there hoping and praying for a miracle. You're a general waiting for reconnaissance reports. Once your scouts confirm the terrain is favorable, you send in the main force. If the scouts encounter resistance, you retreat with minimal casualties and wait for a better opportunity. This is how you systematically extract plus 2R from individual trades. Not by gambling on one lucky spike, but by identifying a developing trend, probing it with controlled risk, confirming it through price action, and then riding it with maximum size protected by accumulated profits. The system works because it aligns your position size with market confirmation, not with your opinion about what should happen. However, there's one critical piece still missing. A fully loaded pyramid is a powerful profit engine, but it's also a heavy structure. If the market suddenly reverses, it can give back profits quickly. You've built a skyscraper of profits, and now you need to know exactly when to evacuate before the earthquake hits. You need predetermined exit criteria that protect your gains without choking off legitimate trends too early. Most traders give back 50 to 80% of their open profits because they fall in love with winning positions. They think the trend will continue forever. They ignore the warning signs that the move is exhausting itself. They turn beautiful plus 3R days into frustrating plus 1R days because they don't know when the party is over. The next chapter reveals the critical timing signals that tell you when to stop pyramiding and how to protect your gains without giving back profits to the market. We're going to examine the specific volume patterns, momentum divergences, and tape behavior that scream the trend is ending. Take your money and run. You have successfully pyramided your position using Livermore's 3-stage protocol. You probed with 30% of your intended size, added 40% on confirmation, and completed the pyramid with the final 30% as momentum accelerated. Your year/USD position is now showing plus 2R in unrealized profit, climbing toward plus 3R. On your screen, you can see the numbers that represent hours of disciplined execution paying off. This is the moment where most traders quietly sabotage themselves. The destruction happens in one of two predictable ways, and both stem from the same root cause: no predetermined exit criteria. Some traders exit too early from fear, watching their plus 2R position climb to plus 3R, then plus 4R, but they cannot stand the emotional pressure of watching floating profits fluctuate. A single pullback candle drops their unrealized profit from $450 to $410. Panic floods their nervous system. They slam the close button just to stop feeling that discomfort, locking in a modest gain while the trend continues for another 50 pips without them. Others hold too long from greed. They watch their position climb to plus 3R, then plus 4R, then plus 5R. They start calculating what they could buy with this money. They start feeling like market geniuses. Then, price reverses. Plus 5R becomes plus 4R. They tell themselves it is just a healthy pullback. Plus 4R becomes plus 3R. They convince themselves it will bounce back. Plus 3R becomes plus 2R. Now anger replaces confidence. They held through the entire reversal and gave back 60% of their peak profit, turning a beautiful opportunity into psychological torture. Both responses are emotional. Both ignore the fundamental truth that separates professionals from amateurs. Exits are decided before the trade becomes emotional, not after. When you are sitting on unrealized profits, you are no longer dealing with risk analysis. You are dealing with temptation. Your original fear was losing 1R. Your new fear is giving back these profits. Your new greed whispers that you could turn this into 10R if you just hold a little longer. Without predetermined criteria, you will exit based on whichever emotion screams loudest in that moment. Jesse Livermore developed his exit mastery through decades of watching the tape, learning to distinguish between healthy trend continuation and moves that were getting crowded, exhausted, ready to reverse. On modern 1-hour charts, we translate that same tape reading wisdom into 3 observable categories that form a complete exit framework: volume climax patterns, momentum exhaustion signals, and systematic R-based profit harvesting. Volume climax: when the crowd arrives. You are holding a fully pyramided position showing massive unrealized profit. The trend has been steady and controlled, with candles of similar size and volume close to its 20-period average. Then suddenly, you see a candle twice as large as the previous range. Volume spikes to 200 or 300% above the average. Social media buzzes with excitement. Retail traders pile into the breakout that you have been riding for hours. This is not smart money entering. This is the crowd arriving late to the party. That massive volume spike represents the final wave of emotional buyers who missed the initial move and are now capitulating to fear of missing out. They are buying at precisely the wrong time. providing liquidity for the professionals who entered early and are now ready to distribute. When your position is already deep in profit and you see that kind of emotional surge, the professional response is immediate. Sell into their enthusiasm. You do not need to nail the exact top. You just need to recognize that the character of the move has shifted from accumulation and controlled trending into frenetic chasing. The smart money that built positions systematically is now unloading into the crowd's desperation. Momentum divergence, the engine losing power. Price continues grinding higher on the 1-hour chart. It even prints a new high, confirming the uptrend structure. But something subtle has changed beneath the surface. The candles are getting smaller despite the continued upward movement. Wicks appear on the top side of candles, showing rejection at higher levels. Your momentum indicators, RC, MACD, or simple rate of change, fail to confirm the new price high. They peak below their prior high even as price prints a fresh one. This divergence warns you that buyers are running out of fuel. The trend may not reverse instantly, but the easy part of the move is probably finished. The professional does not wait for a full-blown crash to react. They begin scaling out into that divergence, especially when already up plus 2R or more. They respect the message. The market is still climbing, but it is climbing on weaker legs. On 1-hour time frames, this often appears as price struggling to push through levels that it used to slice through easily. The market is working harder to make the same progress. That increased effort with diminished results signals exhaustion, even if the trend structure remains technically intact. The 3R rules systematic profit harvesting. This is where we remove all subjectivity from the decision. The rule is mathematically precise and non-negotiable. Once any position reaches plus 3R profit from your average entry, you automatically take 50% of the position off the table. Not if you feel nervous about the market. Not if you think the top might be near. Automatically. Let's walk through this with concrete numbers using our year USD pyramid. Your average entry price ended up around 1.1017 after completing all 3 stages. Your original 1R risk was $167. As the trend unfolds, price eventually reaches 1.1075. From 1.1017 to 1.1075 represents 58 pips of profit on your full pyramided position, which equals plus 3R, approximately $500 in unrealized profit. The moment price touches that level, you execute the rule without hesitation. You close 50% of your position immediately. You have just banked plus 1.5R in realized profit, roughly $250 deposited into your account, immune to any future market reversals. Next, you immediately move your stop loss on the remaining 50% up to lock in another 1.5R if price reverses. You trail the stop to your plus 1.5R level at approximately 1.1025. This creates a mathematical certainty. Even if the market completely turns against you and crashes back through your original entry, your worst-case outcome on the remaining half is another 1.5R locked in when the stop gets triggered. Guaranteed minimum profit SEX 1.5R plus 1.5R, SESTOS 3R stocks 501. You have engineered an asymmetric outcome where you cannot lose, only win or win more. If the trend continues, your remaining 50% captures additional upside. If it reverses immediately, you still walk away with your full daily profit target. You have transformed a winning trade into a guaranteed win, regardless of what the market does next. This mathematical elegance protects you from the psychological torture that destroys amateur traders. They watch their plus 3R position climb to plus 5R, then ride it all the way back to plus 1R before finally exiting in frustration. They turned a potential $500 profit into a mediocre outcome because they had no systematic framework for harvesting gains. Professionals operate like business owners managing inventory. When inventory appreciates in value, you sell portions of it to realize profits. You do not hold everything forever hoping it becomes priceless. You systematically convert unrealized gains into realized cash, then look for new opportunities to deploy that capital. Selling strength, not weakness. Amateurs hold winners hoping for home runs and often give back 50 to 80% of their gains because they fall in love with winning positions. They confuse unrealized profits with actual money. They treat open profits as the market's money instead of their own capital. They refuse to take partial profits because selling feels like admitting the move might be over. Professionals systematically harvest profits at predetermined levels. They would rather sell too early and leave money on the table than sell too late and give back hard-earned gains. They understand that missing the last 10% of a move is a small price to pay for protecting their emotional capital and account equity. Jesse Livermore captured this wisdom in a maxim that every serious trader should memorize. It is better to sell too early and leave money on the table than to sell too late and lose your peace of mind. Your peace of mind has value beyond the mathematical. When you give back large portions of unrealized profit, you damage your confidence for the next trade. You become gun-shy, exiting too early on future winners because you are terrified of repeating the same mistake. But when you systematically take 50% off at plus 3R, you feel professional. You banked real money. You are still positioned for additional upside if the trend continues. That emotional state carries forward positively into your next trading decisions. You trust your system. You are confident in your process. You are ready to execute the next setup with clarity and discipline. The amateur asks, how much more can this make me? The professional asks, how much of this profit can I secure while maintaining upside exposure? One approach is dreaming. One is operating. Protecting gains from market reversals. Your three-signal exit framework creates multiple layers of protection. Volume climax patterns warn you when the crowd has discovered your trade, and smart money is distributing. Momentum divergence alerts you when price is moving without real strength behind it. The 3R rule forces you to pay yourself and convert floating profits into actual account equity. When you combine these elements, you stop treating exits as guessing games. Every decision becomes either aligned with your framework or not. You stop closing trades because you feel like it. You stop holding positions just because they are working, and you are afraid of missing out. Remember, the market will always offer another opportunity tomorrow. But if you give back today's hard-earned 3R because you refuse to execute your exit plan, you are not just losing money, you are breaking your own trust in your systematic approach. That psychological damage compounds over time and eventually destroys even technically sound traders. You have now executed the complete $500 formula. You defined your 1R risk unit. You waited for high-probability setups on 1-hour charts. You probed with small size and pyramided into confirmed strength. You exited systematically using predetermined criteria. You are up $500 for the day. You feel invincible. Your brain is flooded with dopamine and confidence, and that feeling of invincibility is about to become your most dangerous enemy. There is one final psychological trap that destroys even the most profitable trading days. It does not happen during the trade. It happens after the win, in that moment when you feel like you have finally cracked the code and the market is easy. That feeling is a lie, and if you do not have a protocol to handle it, you will give back every cent you just made before the session ends. The next chapter reveals how to protect your gains from the most dangerous opponent you will ever face, your own success. You have executed the formula exactly as designed. You defined your 1R at $167. You waited for clean pivotal points on the 1-hour chart. You probed with 30% of your intended size, pyramided into confirmed strength, and exited systematically at plus 3R. The numbers on your screen show approximately $500 in realized profit for the day. You feel invincible. Your brain is flooded with dopamine and serotonin, all the neurochemicals associated with winning and conquest. You feel like you have finally cracked the code that has eluded you for months or years. Listen to me very carefully right now. This is the moment of maximum danger, not from the market, but from yourself. You are in more psychological peril right now than you were when you were down $100 this morning. When you are losing, your survival instincts are active. You are cautious, defensive, calculating every move. But right now, your defenses are completely down. Your ego is inflated. You feel like the market is an ATM machine that you have finally figured out how to operate. This state is what professionals call winner's tilt, and it is just as destructive as revenge trading after a loss, perhaps even more dangerous, because it feels incredible while it is destroying you. After a successful pyramiding sequence, your perception of risk becomes fundamentally distorted. The psychological mechanisms that protected you during the execution phase, your careful position sizing, your predetermined stops, your systematic approach. All of those suddenly feel optional, even restrictive. Your internal dialogue shifts without you consciously noticing it. You start thinking, I am playing with house money now. You look at that $500 and your brain categorizes it differently than the capital you started with this morning. It feels like bonus money, free money, money you can afford to be more aggressive with, because it is not really yours. But here is the brutal truth you must confront in this moment, that $500 is not house money. There is no such thing as house money in trading. That $500 belongs to your family, your future, your financial freedom, your long-term trading career. It is exactly as real and exactly as important as the capital you started with. The moment you start treating winning profits as somehow less valuable than your original capital, you have entered the psychological danger zone that has destroyed countless traders who had winning systems but lacked emotional discipline. Here is how the amateur destroys a perfect day. He stays at the screen after banking 3R because he cannot walk away. The day feels too good. He feels too smart. He starts scanning for another setup, but his criteria have subtly shifted. The bar for entry has lowered because he feels protected by his earlier success. He sees a marginal setup that he would have ignored this morning, but now it looks acceptable because even if I lose 1R, I am still up 2R for the day. He enters with his standard position size, but the setup lacks the clear structure of the morning trade. Price moves against him immediately. Instead of cutting it according to his rules, he holds because he cannot accept giving back profits unnecessarily. The position continues against him. Now he is down a full R, having given back $167 of his $500 profit. Frustration mixed with disbelief floods his system. He adds to the losing position, telling himself he is averaging in like he did during the pyramid, conveniently forgetting that the pyramid was built into confirmed strength, not against price rejection. Now he is down $200 on a trade he should never have taken. His beautiful $500 day has shrunk to $300. Anger replaces frustration. He cannot accept that he gave back 40% of his gains on one sloppy decision. He exits the losing trade and immediately looks for another setup to win it back. By the end of the session, he has given back the entire $500 and is negative for the day. He turned perfect professional execution into amateur disaster, not because the market changed, but because he could not stop trading after success. The professional has a completely different response to that $500 win. He executes what I call the hard reset protocol, a systematic series of steps designed to protect profits from the trader's own psychology. This is not optional. This is not something you do when you feel like it. This is as mandatory as your position sizing calculations, as non-negotiable as your stop losses. Immediate documentation. The moment you close that final position and realize your 3R profit, you open your trading journal and record everything. Not tomorrow, not later tonight. Right now, while the execution is fresh in your memory. You write down each entry price, each addition to the pyramid, the exact reasons you took the trade, what signals confirmed your thesis, where you exited, and why. You record your R multiples for each component of the trade. This documentation serves a critical psychological function beyond record keeping. It reinforces the positive behavior patterns you just executed. You are training your brain to associate systematic execution with profitable outcomes. Physical separation. You close your trading platform completely. Not minimize it, not leave it running in the background. You shut it down. Then you leave your trading space physically. If you trade from a home office, you walk out of that room and close the door. You go to the gym and channel that dopamine into a workout. You pick up a book that has nothing to do with trading. You spend time with your family. You do anything except look at 1-hour charts or think about what the market might be doing without you. This physical separation is not a reward for good behavior. It is a circuit breaker that prevents you from destroying what you just built. Tomorrow morning, before the markets open, before you look at any live charts, you sit down with a clear mind and review your framework. You check your account balance and recalculate your maximum daily loss based on yesterday's profit. If your account grew from $25,000 to $25,500, your 2% daily maximum loss is now $510 instead of $500. You recalculate your 1R based on your planned number of trades. You review the 1-hour charts in a calm, systematic state and identify 2 to 3 potential setups that meet your criteria. Jesse Livermore lost fortunes multiple times in his career, not because he could not read the market, but because he could not stop trading after big wins. He lacked emotional circuit breakers. He would make $1 million on a brilliant market call, feel invincible, and then give back half of it on impulsive trades taken from euphoria rather than systematic analysis. His greatest regret was not the losses from being wrong about market direction, but the profits he gave back because he could not walk away when winning. Let me give you the complete $500 daily formula in its final form. Define your 1R using 2 to 3% of account equity divided by planned trades. Wait for pivotal points on 1-hour charts with clear stop locations. Probe with 30% of intended position size. Pyramid into confirmation with 40%, then final 30% additions. Exit systematically at +3R or volume climax signals. Execute the hard reset and walk away. Trading is the hardest way to make easy money, but with systematic position sizing and emotional discipline, you transform from gambler to professional operator. The formula works because it protects you from yourself while exposing you to unlimited upside. Your next step: master the identification of pivotal points on 1-hour charts, the high probability setups where this formula becomes unstoppable.